If you're getting ready to retire or separate from federal service, or if you're leaving a civilian job with a 401k, there's a decision that gets made sometimes too fast, and it's one that a lot of well meaning people get wrong. And I want to give you some ideas to combat that. And it's what to do with your TSP or your 401k when you leave service. I can tell you straight up from firsthand experience here in Hawaii, it affects a huge number of us. Think about it. We've got everyone from active duty to retired military. We've got federal, state, county government employees. And then we've got the private sector guys, people like me who may have had a 401k or still in it. And it works very much alike as the TSP. I can tell you, as a business owner, when I entered this financial services industry in 2001, it was an unforgettable year. It was marked by 9/11 at the top, changed the world overnight. Coincidentally, it also was the year the TSP was introduced to members of the US military. The TSP opened in October 2001. So it was a big deal. I still remember it. And a lot of guys were excited because now they could contribute part of their paycheck and reduce their tax burden. So I've dealt with the TSP since then. In fact, by 2009, I had the privilege of serving over 500 active duty service members and their families. So it gave me a very up close and personal experience helping participants both understand, but more importantly, maximize their TSP benefits. So, yes, I'm very familiar with this qualified retirement program. Today is part one. It's going to be a three-part series. I'd like to focus on this retirement account rollovers. And I want to start with the mistake I see most often. And that's the one that can quietly cost people tens of thousands of dollars over a retirement. So let's start with the basics. I want to make this straightforward. Whether you've got a TSP or a 401k, the TSP, as many of is the retirement plan for the federal employees and military service members. I think of it as the government's version of a 401k. It's very much the same thing. It's a defined contribution plan, whereas a typical pension, which doesn't allow you to contribute to, is referred to as a defined benefit plan. Now, with the TSP or 401k, you can contribute from your paycheck, often with a match, and it grows tax deferred until retirement. If you work in the private sector, your 401k is doing the same job. Different name, same structure, same basic decision point when you leave your employer. So here's the moment that matters. You leave your job, you retire, or simply separate from service. Now you have a decision. Should I leave the money where it is, move it to a new employer's plan, roll it into a IRA, or take a mix? It's up to you. There's a lot of options. There is no one universally right answer. But here's the mistake I want you to watch out for and avoid. The mistake is rolling out of the TSP or a low-cost 401k without understanding what you're actually giving up. The TSP in particular has something most people don't fully appreciate. It has some of the lowest expense ratios of any retirement plan in the country. We're talking a fraction of a percent. That's real money that compounds over time in your favor year after year for decades. When someone rolls that money into a new product, often at the recommendation of someone who earns a commission or a sales credit for moving it, that low cost advantage simply disappears. Something it gets replaced with oftentimes is an annuity carrying surrender charges, meaning you're locked in for years and you're going to pay a penalty to change your mind. This I don't like, unless, let's say, maybe you don't have a government pension. I think the calculation comes down to whether you need a source of guaranteed retirement income beyond the pension. If that's the case, just be careful. Don't get sold a bill of good, because I know for a fact sometimes these things get replaced with options or programs carrying much higher internal fee, quietly reducing your rate of return every year without a line item charge you'd ever notice. Here's the part that bothers me most. None of it is illegal. It's not even necessarily bad advice in every situation. There are legitimate reasons to roll money out of a TSP or 401k, but the person recommending it may be operating under something called suitability standard rather than fiduciary standard. It's the one that we live by. Suitable just means the product isn't unreasonable for you. It doesn't mean it's the best option out there. And it doesn't mean the person recommending it has to tell you what they're earning by moving your money. A fiduciary, on the other hand, it's different. Like Steve Financial Hawaii, we're legally required to act in your best interest as a fee-only fiduciary. We don't get paid more or less on which product you choose because we're fee-only, not commission-based. So before you go forward and roll anything out of your TSP or 401k, here are 3 questions worth asking any financial advisor. 1, what am I paying today in fees, and what would I pay in this new program you got to offer? 2nd, is there a surrender charge or any period where I can't access this money without a penalty? 3, is the person recommending this a fiduciary? A good advisor rollovers specifically the paperwork, the timing, mistakes that can create unnecessary tax bills. In part 3, we're going to dive even further. At Steve Financial Hawaii, I want to be able to walk you through how to evaluate whether staying in the TSP or the 401k after separation, if it's actually the right move for you. Because for a lot of people, it may be. And if you're sitting on a TSP or a old 401k decision right now, if you'd like a second opinion, we offer a complimentary intro call. No pressure, no products, just a conversation about your unique situation. So until the next time, be careful, be cognizant of your money. The way you take care of anything else that took decades to build. I wish you aloha, good luck, and take care.